Simon Brown here. We're going to be talking about the Investec International Titans Basket. It's a product which gives an investor an opportunity to access international equity market with a 100% downside protection, a 5% minimum guaranteed return in US dollars, and over the 5-year period, give a potential of an investor double the performance of the MSCI Worldwide Index. It's a truly diversified index across developed markets around the globe. Top 5 holdings are names such as Apple, Microsoft, ExxonMobil, Johnson & Johnson, and of course General Electric. The product is packaged in an offshore listed share which can be purchased with rands or offshore funds. But with that, Yapi, over to you.
Okay, so we're going to talk about the International Titans Basket Limited. This is a company that's existed for the last 5 years and 4 months. The first phase was tracking the International Titans Index plus the S&P 500 with a 50% each allocation, and it was in Australian dollars. What we're going to start off by looking at is the performance of the historic share. It gave 128.95% leverage to these two indices. As you can see on this graph, the orange line is the Australian Stock Exchange. So if an investor put their money in the Australian Stock Exchange direct, the 100 Aussie dollars would have become 112 Aussie dollars. Having invested in the International Titans, their investment went from $100 to $152. Importantly, in the International Titans, it was with 100% capital protection, whereas in the Australian Stock Exchange, obviously all one's capital would have been at risk. So what was achieved here? An ability to give more than 4 times the return with no capital at risk. That's in Australian dollars. And then we'll look at the return in rand. And obviously a lot of our investors come from South Africa with rand. And what's happened here is that if we compare the return of the top 40 index on the JSE, which is the red line, that would have been with recognition that 71% of the market plus minus are rand hedge stocks. Comparing the return there, the market went from 100 to 164. And that's not a bad return over 5 years and 4 months. But the International Titans went from 100 to 244 because 1, the rand weakened against the Aussie dollar, and 2, the markets that we selected in real terms produced a much better return with 128 leverage on the upside. So this shows the power of doing a structured share as opposed to just physically going in the market, both tested in Aussie dollars and in rand.
Copy, if I can jump in at Simon here. The key point here is less so in this one because of currency, but it's that I can't lose. There's that my 1,000 is my 1,000 at the end of the period.
Exactly. So these returns were achieved with 100% capital protection. Had that market smashed, the investor would have walked away with 100.
Yeah, that was my point. If that orange line was right down at the bottom,
yes,
I'd be at the 100. I wouldn't
exactly
be down where it is sitting as well.
Exactly. So the reward achieved for risk taken, and if you think of it from a Sharpe ratio or the like, is a very good reward because you didn't take the same risk, but you received a multiple on the return side. Okay, so looking at the International Titans for the next phase, and this is a phase that opens on the 18th of July and closes as soon as fully subscribed, or 3 October. The new phase will be in US dollars, although the reporting currency of the share remains in Australian dollars, but all the assets are in US dollars. And the index we're going to select for this phase will be the MSCI World Developed Market Index. The investor puts in $100, and the worst case in this one is $105 net of fees and costs and expenses. And this is to compensate the investor in case the markets, which is that major index, goes down, that we want them to have a real principal protection, i.e. international inflation is running at about 1%.
But the bottom line there is worst case scenario, I come out with 105, regardless what happens to that basket within.
Exactly. So investors tend to argue like this. When they know that the stock exchange crashed 40, they come to the advisor and they say, I would have been better off just leaving it in the bank. Now, it's arguable as to whether an investor could in fact get 5% over 5 years where rates are worldwide. Rates would have to move up quite a lot for the worst case to not be better than cash in a bank. Now, on the upside, how we've designed it is that the investors are going to get a 200% leverage from the 5% mark through to 27.5 as far as an index cumulative performance over 5 years. And with a 200 leverage, this means that they can make up to 45% from the upside in the MSCI World, plus the 105, giving them $150 for every $100 they put in. Importantly, that would equate to an internal rate of return of about 8.45. Now, if you consider that worldwide inflation is running at 0.5 to 1%, that's a very stellar real return potential, specifically because you didn't put your capital, even the inflation, at risk.
And that 8.55 must be looked at in global terms, not in South African terms.
Exactly, because it's in dollars,
Yeah.
The minimum investment size here is 12,000 US dollars, or equivalent of 16,000 Aussie dollars. We've got a graphic illustration of what we've just said so that one can compare it to just buying the ETF, which is the normal traditional dotted line. That's on the price only, so from an investor's perspective, one would need to always take into account the dividends you would earn. And later in the presentation, you will see that equates to about 7%. But from the payoff, you can see the red line represents what these investors are going to get. And their objective is to make sure that they get at least 105 and that they can get it up to 150. Because if you think of where the world is at and low growth rates, low inflation, the probability is that it's going to be very difficult to get 50% in dollars in pure stocks. Okay. In this example of the returns, we've demonstrated the various permutations of negative and positive markets and what the consequence would be on the share performance. Bearing in mind that the way the share is designed is that for every $100 we get as subscriptions, we're going to put a portion of the money in bonds issued by Investec Bank South Africa, which are going to yield us US LIBOR plus 5.5%. If you think about it, for every 100 we put in, we're going to put aside roughly 75, which will accrue interest and mature at 105 over 5 years in this Guernsey company. Secondly, we're going to put aside fees for costs, expenses, distribution fees, etc. And those will be roughly 7.5, and they'll be amortized over the 5 years to naught. And then lastly, we'll have 17.5 left over to buy this 200% geared call option between 5 and 27.5. So that's the detail of how it works inside this Guernsey company. So from a payoff profile, that's the table. As far as the type of bonds that we have, the bonds are issued by Investec South Africa as a new Tier 2 capital bond. These bonds have to be issued to be a 10-year legal tenure, with the bank having the right to buy them back after 5 years. The bank will most probably buy them back simply because if they don't, then the regulators cut their recognition by 20% per year for the fact that they didn't call the bonds. The other thing that's important is that if they don't call it, then it becomes a quarterly callable by the bank, and the comparative deposit rates for quarterly deposits is about 0.6%, and the bank would be paying arguably 10 times that to the Guernsey company. So it will be commercially not, that smart not to call it.
The bonds are important because that's how you provide that guarantee. You mentioned it a moment ago. You take the notation, let's say $100, you put 70 out of it in a bond that in 5 years will give you 105.
Yes.
And therefore, there's your guarantee. Really nice and simple, no complexities there at all.
Absolutely. So what you want to make sure as an investor is, how is it that Investec can promise me this 105? Well, we can promise it because we know that the nature of the bonds and the interest rates we contract on those bonds will take us to 105. Yeah. Now, in the unlikely event that the bank does not call the bonds at the end of 5 years, what will happen is that the profits from the equity upside, that would be paid out as a special dividend. And as we know, foreign dividends are taxed at 15%. Mm-hmm. And then the 105, which the bond matured at, would attract this interest, and the shareholder would get an annual dividend at US LIBOR plus 5%, which if you think of the credit quality of Investec, that would be a fairly good return to get as a dividend, which is not taxed as interest, but as a 15% dividend tax. But it's a very unlikely event. The liquidity of the shares, there are 3 levels of liquidity. Firstly, willing buyer, willing seller, because the shares are freely transferable. and that's been what most of our sales over the 15 years that we've done these offerings have resulted in. We've had less than 1 to 2% of people actually sell these shares early in our experience over a long period of time. And they shouldn't be sold to investors as a trading instrument. They're not a trading instrument. They're part of the core portfolio, which is best held for the full 5 year.
This is more a case of, we have plans. I think I can put this money aside for 5 years. Life throws me a curveball. If I need to, I can.
Exactly. So in the event that there's no willing buyer in the market, then Investec, we have a portfolio of capital, which we can buy the shares from a prospective seller. In that event, there's a 1.25% early redemption fee from the prevailing market price. And the prices are on the internet and on Bloomberg on a daily basis, real time. So it's easy to access what the price is. Third level of liquidity is if we don't want to buy as Investec or there's no willing buyer in the market, then we unwind the assets, i.e. the cash that hasn't been paid out as fees and costs is cash in the bank account of this Guernsey company. The options are bought and contracted to be daily price and daily liquid, and they are available at the price that they included in the share price. And then the bond is sold independently in the market to prospective investors. And if you think of the rate, we earning roughly 6.5% in US. Investec has a similar bond in the London market, which is in pounds, and that's yielding at the moment 5.4% in sterling. So we think that 6.5 would be much more attractive. So we'd get that away by selling it to an independent buyer. Then if we look at what is this index that we've targeted, well, you would recognize it as being one of the major indices used by the active asset managers, the MSCI World developed markets. Specifically selected because, most of our investors are in South Africa and they're in an emerging market with probably enough exposure to emerging markets by their pension funds and their retirement annuities and the other assets they ordinarily own shares on the market. This index covers 23 developed markets and has got 1,649 constituents and making up most of the free float of these major markets. As to the valuation, at the moment the PE of the index is running at 20.9 versus a long-term average of 21.3. So probably a reasonable fair value or slightly cheaper than fair value. The benefit of having index exposure, and this is why some people allocate money to passive investments, is that as the index changes on a quarterly basis and orchestrated by MSCI on a formulated basis, it enables the investor to have exposure to the best sectors and at the shares that are doing the best at any given point in time. And also the country allocation is done with reference to what those stocks that this index selected, where those shares are registered. So for example, at the moment, the United States makes up 59% of the asset base. But if they push up interest rates in America over the next year or two by 1 or 2%, because their economy is doing quite stellar, it could have the consequence that comes down to 40% in this index in, say, 2 years' time. And that would be great for the investor because the equities in the US might slow down and the investor just wants exposure to the shares that are doing well. So it enables a reweighting dependent on where the value is being created.
That's the critical point of this sort of, which goes across not only different sectors, but different geographies.
Yeah.
As you say, America's struggling. Someone's picking up that slack, and I'm going to see it here. It autocorrects. It will pull down America. It will boost whoever it is, France, Japan.
Exactly.
We don't know which the area will be, but it autocorrects itself in that sense.
An important thing is the way that the share is structured by buying this double exposure by call options on the market. The investor doesn't have the costs associated with buying the right share, knowing when to buy it, knowing when to sell it, to reorganize and rebalance this lot. So the comparative to the active world is that someone would have to be very competent knowing which shares to buy and sell and when to give him double the performance of the index. This is not an easy task.
Yeah, first you've got to pick your geography, then your share, then your I mean, I don't want to say it's impossible, but I'm going to say it's not going to be easy.
Exactly. Across 1,649 shares.
In 23 different economies.
Yeah, very tough. At the moment, the top 10 shares are these major US, I'd say information technology probably dominate. But the reality is, once again, if for whatever reason technology changes as quick as we know it can change, the reality is then those stocks might be less in 2 years' time. And this is what the investor wants, exposure to the shares that are doing well. But there's a very low risk of concentration to any one share. So if any investor in the ordinary course of business goes and buys 10 shares, there might be great blue chips today, but technology or new energy or something out there could result in that share losing massive amount of value, as we've seen with oil companies, as we've seen commodity stocks. And if you had only 10 in your portfolio and one of them got really hurt, it'll have a huge impact on you. Whereas with an index like this, Apple, as big as it is only 1.72% of the total.
That's a good point, because there are 1,600 plus stocks here. So
Yeah.
Apple's your giant in there, but in truth, only 3 are above 1%. And I
Exactly.
imagine the vast majority are really down at a fraction of 1%.
Yeah, exactly. So the real thing here with this asset class and with this type of design of the share is if you look at the 30-year history of the MSCI World, a lot of people could be under the impression that as long as I own the big shares and the heavyweights and the blue chips, then I'm fine. It's not true. If you look at this 30-year history, you can see here with the 2001 and the 2008 crashes, that the drawdowns in those markets can be very, very significant via the systemic risk of the market. So the reality is that an investor who loses 40%, needs the market to recover 65 to get back to where he was. So having this ability with hindsight to opt out for 105 when everything went down 40 is hugely valuable in the context of 0.5% risk-free in dollars in world markets. So the share design, it really goes to the heart of what people want. They want to make a lot of money in real terms if it's good, but they don't want to lose their money when it's bad. But no one knows if it's going to be good or bad. So this really picks up that which the human side of the psychology takes them to achieving.
Yeah. And it's that, you made the point, I want to reiterate, down 40%, I've got to get back 65 to get back. But it's also that duration. It takes a number of years to actually get back to that point. So, we could look at it as in terms of the performance. We can look at it as time lost at the same time.
Exactly.
We've been sitting here. Yes, we get back to where we were, but that has been, 6 years that we have basically, at the end of the day, gone sideways.
Exactly. So that's that asset. Then the rand, if you look at the rand forward against the dollar, with the differentials in our interest rates or the differentials in our inflation, this is not Investec's opinion or our view. It's just straight off the forward curve, which you could get from any bank, but effectively showing over 40% expected devaluation over the next 5 years. And obviously these assets are all in US dollars. It's important to take into account that when you're investing in an index, you don't get the dividends. So we've depicted here the amount that you would actually lose after ETF fees, which is your cheapest way to access the market, and tax on dividends. Circa 7% would be the amount that you would lose over a 5-year term. And that 7% you would arguably be able to add to that dotted line that we initially looked at as to the market line. But, it doesn't give a lot of protection, because if the market goes down 37 and I say to you only lost 30, you're still not smiling.
You're not happy by the least.
But the important point here on this page as well is the fact that to have this protection, which we're getting from the bond, is the same as commercially having to go buy a 105% put option in the market. And if you had to do that, it will cost you 22%. So the protection here is not being achieved by going like we do with our home insurance and our car insurance and buying and paying a premium for something. It's too expensive with the current volatilities in the market. So the way it's achieved is that this Guernsey company gets that from the Investec bond. The back testing on this offering shows that tested right back to 1986, more than 25.5% of the time investors who invested and got the dividends wouldn't have got 105 out at the end of 5 years. It's that 25.5% that's hurtful for the advisor, where the client is losing money and his risk profile really, he realizes he can't have afforded to lose that money. It's in hard currency with a very low recovery at the bank, risk-free. The second point is if you do look over an extended period without taking the risk into account, just looking at your returns and adding the 7 dividend in, the physical market would have been better than the product. And the product would have been, it's just less than 50% of the time the product would have been better. But on average, the 5-year rolling returns of the index were 33% pre-dividends. With dividends net would give you 40, and for the same payoff, the share would have done 50. Now, the difference between 50, which was the average return on the structured share, versus 40 in the market, being 10% for 5 years, is roughly 2% per year. Now, this is 4 times risk-free. So, in the context of exceptionally low interest rates, 10% difference is huge, because that's now before you taking into account the rand dollar.
And it's also that, again, the protection. I don't get that quarter of the time when actually I would have lost money in the process.
Exactly. And the nature of these shares, for those who haven't had exposure to them, is such that this is a rollover of that share we looked at earlier with the return statistics. The shareholders who keep this original share that they bought, they lock in that 53% Aussie dollar profit, or 54, and they have no sale. So they have no capital gains tax event. But commercially, they've locked in that profit, deleveraged their risk, because the capital guarantee now goes to 1,500, and they stay with equity as their asset class. Lastly, the fees. The distributors have the discretion to charge 0 to 2 upfront. That does not form part of the capital. And inside the share, with all the fees and costs are built into the share, is the expense provision of 1%. We normally don't need that, and we pump into a more powerful option. And then the annual fees to the distributor, which is the advisor, financial advisor, is 0.65. And similarly to us as the investment advisor to the company, which is Investec. And in the unlikely event that does not get called after 5 years, then those fees drop to 15 basis points each as the maintenance mode. And the investor is still able to get that 5% above US LIBOR as an annual dividend. So that's the essence of the share. And there's some contact details.
In a sense, really simple. I'm not getting a guaranteed money back. I'm getting a 5% guaranteed money back, which is done without having to, nice simple bonds, nice and simple. And then if the markets go up, I'm going to get some upside there. There is a cap, but I don't think anyone's looking for our markets to storm ahead. I'm not making predictions because no one knows the future, but it gives me that underpin that says you're going to get your money back no matter what happens. And hey, if things go slightly well, you're going to do great.
Yeah. I think that the fact that the investor here can get this 50% dollar return, only needing the equity market to do 27.5, is very, very important, because it will be very, very difficult for someone to, in a low growth scenario, pick shares that could give that type of return. Now, where the asset class, where this fits into the portfolio allocation, it will just be a part of the allocation, because obviously with the risk to the bank and to the provider of the options, you have credit risk to the banks. So it would fit together with other physical high conviction stocks.
Yeah.
And bonds and cash and other assets in the total allocation.
Yeah, this sits at a core of a portfolio.
It's a core portfolio.
We'll leave it there. Thank you very much.
Thanks.